Welcome, ladies and gentlemen, to this investment performance and market update on behalf of the ASA Diversified Property Fund, and thank you for taking the time to join us this morning. My name is Tim Slatter, and I'm one of the two managing partners of ASA Real Estate Partners. I'm joined by Jonathan Senior. Jonathan's the fund manager for the ASA Diversified Property Fund, who will be providing an update on the fund today. And we also have with us Mr. Howard Brenchley. Howard is the independent chairman of ASA Funds Management Limited, the responsible entity of the ASA Diversified Property Fund. We believe these webinars represent a good opportunity for investors and advisors to hear from a range of the investment professionals across the ASA platform, and Howard has been a very successful and active property investor in listed and unlisted capital markets in Australia for over 35 years. So we hope that you will find his perspective interesting in terms of where we are in the current property cycle, and also we've invited him here to talk in his capacity as chairman of the responsible entity board on the fund and also on the fund's recent capital management decisions. So I wanted to let you know, for your convenience and for any of your colleagues or clients that may be unable to make today's presentation, that the session will be recorded. It'll be available on the website and also emailed to all registrants later on today. I also wanted to draw your attention to the Q&A functionality that we have in operation, so feel free to submit any questions as we go through the portal at the top right of your screen, and we'll attend to the questions at the end of the session. So while it may feel like a long time to go for many of us, ASA Real Estate Partners took over as the manager of the Diversified Property Fund from Australian Unity on the 28th of June this year. While we've had the privilege of meeting a number of you since that time, if you missed our previous webinars, we presented an overview of ASA, including our experience and our track record, which you can access on our website or by contacting us. But we'll take that as read, given the volume of the material that we're hoping to get through today. So at the outset of the session, we did have a couple of questions regarding the transition of management and the timing of the temporary suspension of the fund's cap withdrawal facility that we wanted to deal with at the outset. So since taking over the management of the fund, ASA has continued to operate the fund consistently with Australian Unity's approach. So we have not altered the fund's portfolio, the day-to-day management of the properties, nor altered the fund's key features, including daily unit pricing, the fund's target gearing levels, as well as its monthly distributions. We have significantly increased the rate of the monthly distributions as a result of the developments that have been completed and which are now largely fully leased up. We have improved the governance of the fund with the implementation of a new board that has a majority of independent directors, and we've also brought across the fund manager and portfolio management team, and we've bolstered them with the support from our own expertise. And as part of this, we've identified a number of additional opportunities to generate additional income and value through asset management initiatives across the portfolio in the short to medium term. So what has changed over this period is that further asset sales, in addition to the asset sales that have been undertaken to date, have not been able to be realised on terms that, in the board's determination, represented the best interests of all unit holders. Now, we're very cognizant of individual investor circumstances, but I would like to make the observation that there are a distinct minority of investors that are seeking to access liquidity at the current time, and of course our job is to manage the fund for all unit holders. So in addition to the asset sale program, the independent revaluation of our property in Busselton was completed, and that's resulted in the percentage of debt to total assets in the fund increasing to approximately 49%, which is beyond the upper end of our target gearing band of 35 to 45%. As a result, the board determined that the prudent course of action and the best course for the fund's investors as a whole was to temporarily suspend the capped withdrawal facility. Now, the key factor for the recommencement of withdrawals is for the fund's gearing level to come back within the target gearing range outlined in the fund's PDS. So this needs to be undertaken methodically through a combination of potential asset sales as well as the introduction of new equity to ensure that the fund can continue to meet the best interests of all investors and strike an appropriate balance between maximising investor value on the one hand and delivering liquidity on the other. So in terms of the specific timing for the recommencement of the operation of the capped withdrawal facility, we expect some time will be required to go through the steps that we have outlined. And given the nature of those steps, it's very difficult to provide a precise date. However, at this point, we do not anticipate for this to be before the 1st of July 2025. So for context, the fund has delivered annualised returns of over 10% per year for over 10 years. And we are working very hard as our first priority to ensure that the fund continues to deliver excellent returns for all investors. Now, we appreciate some investors from time to time have much more urgent and pressing liquidity requirements, and ASA Real Estate Partners intends to provide correspondence in the next 2 weeks on an accelerated liquidity facility, which may be helpful for those investors in this regard. So in preparing some comments on the market and reflecting on the period since taking over the management of the fund, our work has really reinforced to us the quality of the real estate that the fund holds. And that's sat behind and it has been a large part that the fund has generated a very consistent and strong level of returns. It's very attractively positioned with 85% of the portfolio being in very well leased retail properties. And this has reinforced our confidence in the fund's ability to continue to generate strong risk-adjusted returns, including relatively high monthly cash distributions into the future. So on slide 4, we have put together some observations on the market and what that means for real estate investment in the current environment. We've sought to keep this at a reasonably high level and we'll move through it reasonably quickly. However, please feel free to contact us if you would like to get into any further detail on any of the topics covered today. So starting with the Australian economy, we've continued to see a continuation of output or GDP growth over the year, which has followed really a record run of over nearly 20 years. However, you will notice that the rate of growth has been getting smaller and smaller. And in fact, if you looked at the country's growth on a per person or a per capita basis, you would not see the positive 1% figure on the chart on the right-hand side. You would actually see a figure of negative 1.5% for the year. So while the country's productivity is no doubt a factor, we have also seen a period of much higher inflation. Perhaps not the 15 to 20% that was prevalent in the late 1980s and early 1990s, but still much higher than it has been at 5 to 6% annually, as you can see in the chart on the left. This probably fits with our own experience. Anecdotally, I think we all recognise that we have filling up our cars and having had, experienced grocery shopping. $100 goes, not nearly as far as it used to. Now, this has caused the Reserve Bank of Australia to raise interest rates to quell inflation. You can see in the chart on the right there, we've seen rates rise by a little over 4% in a relatively short space of time. This has also meant that real investment returns have been eroded. So, cash, for example, in a term deposit earning 5%, if we have 3% inflation, the real effective return is 2%. And perhaps not surprisingly, the increase in inflation, the cost of living, has hurt consumer sentiment. You can see a significant fall in the chart on the left there. However, more recently, we've seen that the interest rate environment and the outlook has changed considerably, and it has moderated. You can see there consumer sentiment has turned the corner and picked up, and also you'll see on the right-hand side that deposit rates and interest rates have turned over. So, this was the RBA's $10,000 12-month deposit rate data. So previously nearly 5% back to a little over 4% per annum. So in terms of taking all this and asking the question, well, what does this mean for commercial real estate investment? As property investors, there is a lot we could say on this, but I just wanted to share a few selected observations on this. And I think the first thing is in regards to inflation, as a real productive asset, it is a good natural hedge. We've seen nearly all of our leases hold fixed or CPI-linked annual increases. So as we've seen costs increase and CPI increase, we've also seen rents increase, and that is a key driver of the fund's cash flow. At the same time, we can't ignore the fact that costs have increased. Those costs and things like cleaning products, wages, transportation, cost of goods for the businesses that are our tenants that we're also very conscious of. However, as a property investor, one of the great things is that we are largely insulated of this. We're not exposed to monthly or weekly trading performance of the businesses. They have a good or a bad period. We are still receiving a monthly cash rental income payment, which delivers a very stable and consistent cash earnings stream. I think the other key observation regarding the higher cost environment we've been is that if one considers the replacement cost of the portfolio, and that's both thinking about it from a valuation perspective, but also from a competitive perspective in terms of the risk that another party may develop a property in a competing location with one of our properties, the costs of replacing our assets are considerably greater than what they were previously. So leaving our twin service centres at Wyong, which have 20 years worth of cash flow aside, the overall portfolio's estimated replacement cost is approximately 30% higher than the current carrying value. So that provides a very positive underlying support for the valuation of the assets. In terms of interest rates and the environment there, I think with a market expectation of moderating interest rates, we expect that this will have a number of implications for real estate. So the first one is that, just generally that it becomes a relatively more attractive asset class as the cash yields being delivered by real estate and including the diversified property fund look increasingly more favourable relative to where the yields coming out of a cash investment may be. Obviously, there's very different considerations for both investments, but from a simple cash generation perspective, there's a widening gap there. The second thing is our borrowing costs reduce, and real estate borrowers, the cost of debt comes down. That obviously provides more free cash flow back to equity. And typically, we also see that as long interest rates come down, we see that cap rates generally come down, which generally causes an increase in property valuations. I think the final observation on the implications for real estate investment is that there's been a very significant divergence in performance between asset classes. In the diversified property fund, we have 85% of the portfolio in very well leased retail assets, which are very well weighted towards non-discretionary essential daily spending. There's a very different dynamic if one considers the office market. So with retail property, we saw through the advent of online retail, pressure on rents and questions about sustainability. Largely that has been resolved, and we can see now that the retailers have figured out there's certainly an opportunity to have a multi-channel, a bricks and mortar and an online retail. We can see that. We can also see that through COVID, with rents being significantly rebased, we now have much more sustainable rents in the retail property sector, as well as cap rates and valuations having been rebased. On the other hand, if one considers the office market and environment there's still a fundamental oversupply of office space in the majority of office markets, and increased in capital expenditure requirements to maintain those buildings and make them leasable, increased incentives, and a much lower amount of investor demand for those assets. So with that, I think that really leads us to conclude that the retail property and the fund's portfolio composition stands it in good stead for its the continuation of its investment track record. So with that, I would like to thank you, and to hear more about the fund and the portfolio's performance, I will now hand over to Jonathan. Thanks.
Thank you very much, Tim. Again, thanks everyone for joining us this morning. I'd like to reiterate Tim's comments that the September quarter has been a particularly busy period for the fund, with the management transition to ASA Real Estate Partners now complete. The fundamentals of the property portfolio remain extremely sound. Our occupancy is nearly 99%. Our weighted average lease expiry is 10 years. and we have minimal tenant arrears, and all this underpins our current level of distribution of 0.6 cents per unit per month, or 7.2 cents per unit annually, which at the current unit price is 7.1% yield, which is 70% tax deferred. So again, that's a very attractive income metrics where we stand at the moment. In terms of key activities that have been undertaken for the quarter, and I'll just ask that we flick onto the next slide, please. The ASA team has completed strategic asset reviews and has been out to all of the sites for the fund's properties, and as part of that process, there have been a number of income and growth opportunities that have been identified, and these will be rolled out through the balance of the current financial year. We've had a number of new retailers open, including a shaver shop at Busselton Central and the La Croix Bakery at Blackburn Square. Council approval has been sought for a new large digital screen at the Williamtown Aerospace Centre, and we've also got some works underway to increase the specialty shop footprint, which will also drive higher income at the Dog Swamp Shopping Centre in Perth. In terms of other goings on within the fund, Busselton Central has been awarded the Best Retail Development at the WA Property Council 2024 Awards, and the Busselton Tavern also won Australia's Best Wine Bar in the Gourmet Traveller 2024 Awards. Well, the activity, as I mentioned, hasn't been just limited to property matters. On the debt financing front, we have a debt expiry in May next year. We've been actively addressing that, and we have now agreed terms for a new and extended loan facility, which brings improved pricing on board, which will ultimately flow through to income and distributions. We're targeting financial close of this new facility by the end of December. It may creep into January, but what that will mean is that the first debt expiry post implementation won't be until either December 2027 or January 2028. So been very active on that front in dealing with that issue. We also took advantage of some lower rates in the swap market in September, and we actually locked in another $100 million of hedges out to July 2027. So that leaves our hedge book in pretty good shape from this point, especially when you consider where interest rate futures markets have moved subsequently. As Tim mentioned in his opening remarks, the fund's gearing does remain at 50%, which is above the upper end of the target range of 35 to 45%. And related to this was the decision to temporarily suspend the fund's cap withdrawal facility. In respect to this, I can assure you that we are very actively pursuing a number of capital management options for the fund, and with the objective of bringing the gearing back into the target range. And this includes very, very active promotion of the fund to try and introduce new equity, and also pursuing asset sales, which we're very conscious of doing in a prudent manner that won't ultimately end up in a result whereby all the investors' equity is significantly impaired because of making a poor decision in this regard. We can just jump on to the next slide, please. So I'll just like to conclude by just reiterating that property is a long-term game, and this fund has performed over the long term, as you can see on this chart. There's been a 10-year return per annum generated of 10.3%, or 2.7 times the equity in over this period. So the fund has proven with the portfolio that it has in place to deliver, and we continue to focus on driving that performance into the future. I'd like to thank you all again for your ongoing support, and I will now pass on to our independent chairman, Howard Brenchley, who will reflect on his views on property cycles, having been a participant in many of them. Thanks, Howard.
Thanks, Jonathan, and also Tim before him. I am the chairman of the responsible entity for the fund, and for those of you not fully aware of the structures, the responsible entity acts like a trustee and is really its primary interest is to safeguard the interests of the investors. ASA Partners are the investment manager for the fund, and their role is to manage the investments of the fund and provide the best possible returns. Now, just having a look overall and the sort of big picture focus, we all know that investing in commercial property carries risk, and capital values can rise and fall. However, the volatility of commercial property returns are tempered by a number of factors, which include the lead time required to add to supply, the lower liquidity in the marketplace for commercial property due to the difficulty in trading the physical asset, and the high component of relatively predictable income from rents, which over time comprise 50 to 70% of total return from commercial property investment. And that compares with shares, where your income stream will be less than, in most cases, less than 30% of the total return. So over time, commercial property investors that can achieve effective and long-term income streams will give themselves the best opportunity to achieve sound capital growth. Now we can see on the right-hand side of that slide, the top slide looks at asset class returns over time. But I think the bottom chart there, Australian property returns over time, is quite an interesting one. And that chart starts in 1986, which funnily enough was when I started in the industry. So I hope I'm not showing my age too much here. If you look at that chart, you can see the yellow part, which is the income stream, is pretty consistent over that nearly 40 years. It's the blue chart, a part of the chart that shows the capital value increases and decreases that's the most volatile. And really over 40 years, we've had 3 periods where capital values have declined over the commercial property market. The first one was in the early 90s, which as the older people amongst us in the audience will remember was the Keating recession that we had to have. The second one further down in 2008, 2009 was the global financial crisis. Again, a fairly traumatic period where banks stopped lending and basically the commercial property market transactions stopped altogether. And the most recent one there, only 3 or 4 years ago, or the last 2 or 3 years, was the COVID downturn. You can see a little blip in the most recent period. That's, I hope, maybe short-lived, but a lot will be dependent on the outcomes from the last week's US elections. But apart from those 3 periods where capital values have fallen, total return from commercial real estate in Australia has been relatively consistent at around 8 to 10% per annum. And certainly over the long term, that's the return that's been achieved. Now, because real estate assets, and in particular the land component of those assets, have relatively stable values, banks and other lenders are more prepared to lend against real estate security. This allows investors to leverage their returns using debt. However, it's not all good news, because this leverage can also operate on the downside. So it's incumbent on managers of real estate portfolios to prudently manage their capital and apply conservative use of debt to provide long-term competitive returns. Now, in our specific case with the ASA Diversified Property Fund, despite the fact that the portfolio is of high quality, at the moment the gearing, which is currently at almost 50%, is higher than we would prefer for prudently managing that portfolio. Our stated target range for gearing is 35 to 45% of total assets, and lowering to this range can be achieved by increases in asset values. Obviously, that's subject to market conditions. Asset sales, again, being able to sell your assets at a good price, and raising new equity, which Jonathan has already discussed. Unfortunately, releasing equity, and that would be through redemptions, would have a negative impact on this objective. So it was with this objective in mind that the board determined that it would temporarily suspend the capped withdrawal facility to provide the management team clear air to implement its strategies. And this pause will allow us to explore potential asset sales without a sense of urgency, and also allow us to reinforce our relationships with our lenders. Achieving the aim of returning gearing to our target band will provide an environment where the fund will be better able to withstand any, or if there are any, future revaluation declines, and then the board will be more comfortable in reinstating the capped withdrawal facility. Thank you for your time and attendance, and I'll pass back to Tim. Thanks, Tim.
Thanks very much, Howard, and I hope everyone appreciated the opportunity to hear from the independent chairman of our responsible entity. Just picking up on a couple of the points, I would like to draw everyone's attention to the fund's most recently quarterly update, which is also available on the website. That goes through the fund's key occupancy and performance metrics, and we've got a good amount of information asset by asset. Also, we have an overall investor presentation. If anyone would like a copy of that, I would encourage you to get in touch with us, and we can take you through that. So we have had a couple of questions here that I will allocate. The first one is in regard to one of our properties in Western Australia, the Busselton Central Shopping Centre, which was recently redeveloped. The question is, how is Busselton going? So Jonathan, I will invite you to respond to that question.
Thanks, Tim. I think sort of where we're at with Busselton is that we're getting there with that asset now. And the quality of the assets now being more broadly recognised. And as I touched on in my presentation, it's only recently been awarded the best retail development in Western Australia by the WA Property Council. And again, like with more visitation down there, things like the Busselton Tavern and its wine bar are being recognised, and that was recognised with that Gourmet Traveller Award. It's a very popular region in Australia. For those of you who haven't been there, Busselton's also been awarded the WA Top Tourism Town in 2024 as well. So, tourism accessibility to the area from the East Coast in particular is growing. March this year, direct flights commenced into Busselton from Sydney, and that's on top of the service from Melbourne, which we catch regularly when we go over there to visit the asset. So it's certainly in terms of the recognition of the town and the asset, that's really starting to catch on. In terms of the trading performance of the asset, sales from the cinema we're now seeing that pick up. Market conditions weren't ideal, unfortunately, when we launched the development, and there was very little cinema content due to the actors' strike that took place in the US, and that has a flow-on effect, given that it's a key pillar of the shopping centre into trading activity across the balance of the centre. Like, pleasingly, that cinema performance is now back in line with the Reading's budget, and that's important because it's driving a lot of people through the asset, and as they're going through the asset, they're spending money at the adjacent retail tenancy. So we're seeing improved turnover performance from the cafes and the bars in particular. We've got one vacancy to fill there, which we are actively pursuing and hopeful, given the seasonal nature of the asset, that we can lease that over the next 2 to 3 months. We've also made some changes to the management on the ground, and we've got some particular promotions that will run over the busy holiday period to improve the turnover performance of the asset, and at the same time also reduce the operating costs which the centre's incurring at present. So I think we're positive here, given that, and we need to be cognizant that the time will be our friend with this asset. It hasn't traded through a peak summer period in optimum form yet. It will this year, and we will come out of that stabilisation phase in a good place, and it will gain more recognition as the busy summer period plays out. And with that, over time, value accretion, which is what we're all about.
Sorry, everyone. Thanks for that, Jonathan. There's a question here regarding the debt expiring in May next year. What risks do you see relating to this? I'm happy to take that one. So ASA has levered its relationships with the big four and some of the larger offshore banks that we've had from our time in the market in previous roles. There's a lot of demand to lend to this portfolio as they see the banks, that is, see the income quality and the non-discretionary nature of the assets as being very robust. So we're currently legally documenting the new facility. We'll refinance all of the tranches expiring, noting that we have current expires in May 25, May 26 and May 27. New expires will likely be in January 28 and 29, which will remove any near-term risk and also lock away attractive pricing from the bank. So we are aiming to have this resolved and finalised before Christmas, and we'll report back to investors in the new year. The next question is regarding the digital screen, the out-of-home advertising board at Williamtown Aerospace Centre. Jonathan, the question is, what is the significance of the new digital screen? I'm assuming that is regarding the income and valuation impact on that asset, but I'll invite you to take that one.
Yep. Thanks, Tim, and thank you for the question. Yeah, we're pretty excited about this opportunity. The application is with the council at the moment. We are hopeful that we will get a positive outcome through their planning process. It's a significant sort of statement on the corner of the property. For those sort of familiar with the asset, on the entry road into the Newcastle Airport. I won't go into the detailed commercial terms of the proposed transaction, but I can pretty comfortably say that will have a positive valuation impact. There is material income upside from that opportunity, with not a great deal of capital costs. So we would expect that to have a positive outcome on the valuation of the property.
Yeah, thanks for the question. I mean, that is one of a number of opportunities that have been identified across the portfolio. And really, they are some of the better types of opportunities, as Jonathan mentioned: low capital cost, significant income uplift opportunity, and obviously that income is what goes into the valuation of those assets. You can see average cap rate just under 6% across the portfolio. That capitalising that income obviously translates to the valuation of the portfolio positively. And I think there's a number of opportunities we've identified like that. There's a question here regarding the replacement cost, which is basically saying higher replacement cost also requires a high level of income. So that is correct. The comment we were making earlier is that the valuation of the portfolio at one level, the cost of replacing it is 30% higher. So a competing developer, all things being equal, would require 30% more rent from the tenants in order to get that valuation and that development feasibility to stack up. So that does sort of come back to the point we were trying to make, which is that the more it costs to replace an asset in some sense means the more value there is in the existing portfolio. There's also a question here. There is a question regarding the future earnings fund. So we're not able to give you a sort of long-term earnings forecast for the fund, and clearly we are at pains always to point out that past performance is not necessarily an indicator of future performance, but what we can point to is obviously the fact that we've got a very robust portfolio. The occupancy of the portfolio is exceptionally high. It's nearly fully leased. We have an excellent weighted average lease expiry of approximately 10 years, which gives us good income visibility, and the sorts of businesses, being some of Australia's best known retailers, all bode very well in our view for the cash flow and the prospect for strong ongoing risk-adjusted returns. So with that, we would like to conclude today's presentation. Thank you sincerely for your time in joining us. If you have any questions that you have for us that are specific that we haven't dealt with, we will respond individually, and feel free to reach out if there's any more information or other questions you have between now and the next time that we are talking. Thank you and have a great day.
Yeah.